One of our roles is really to try and focus, our colleagues' minds and try and inform our, investment committees and our clients, CIOs and allocators. First of all, where are we in the cycle, or I should say, where are we in the cycles? Obviously we have the underlying fundamental cycles. That's the economic cycle, which actually then leads to the demand and supply for real estate, and then ultimately we have the capital market cycle. So if you just look at where we are in terms of positioning 8 years, 9 years after the GFC, you just have to take a hard look at those numbers, transactions, pricing, and just ask yourself, irrespective of those big shocks or potential risks, there is something out there about portfolio insurance or insurance policies for portfolios given the cycle. And then you add another thing to that, which is shocks. You talked about some of the geopolitical. Migrant crisis is one. Brexit on the 23rd of June is another one. And you can name, you can have a list of 10 at least to scare yourself or scare your colleagues about these. And I guess they are massively important, but one of the things we really want to focus on is each individual fund manager or portfolio manager should have a clear set of strategies responding to different scenarios. That's really what we are trying to focus on. It's not about, is this event going to happen? We can give you a probability to the best informed manner. We can have a series of models, we can take others' views, surveys, etc. But the key thing is really about what would you do if this were to happen? And the question is not whether will this happen, is what will you do? You're going backwards today, or even what should you have done a few weeks ago, a few months ago, were this to happen. So I guess out there, the capital market cycle is the key, number one thing we have to manage. And the other one is, of course, I think Brexit is probably a close number two in terms of shock or changes in trends in terms of risks out there. But we can then discuss how we would deal with those within individual portfolios.
Donald Rumsfeld called risk, actually categorized them into the known unknowns and the unknown unknowns. I think you can have wonderful state-of-the-art techniques and procedures in place, and I think, Charles, you guys are capable of helping people to do this when it comes to the known unknowns. In terms of interest rate shocks, in terms of economic downturn, and what does it make? What does it cause to your top 10 tenants in your portfolio and all that stuff? You can model and, as you said, stress test these things. When it comes to the unknown unknowns, and I wouldn't call Brexit an unknown unknown, because Brexit is an uncertainty at the moment. It's already causing people to be careful about the UK or about speculative kind of development in London, UK. On the 23rd, for 24th, we know more. When we're unlucky, it's going to be a prolonged state of uncertainty, because if then the Remain fail and the Brexit win, it's going to take years before you actually find out what does that mean for the UK economy and therefore for the overall European economy. So I think you have to differentiate between the known unknowns, the kind of changes in the overall framework which you can allow for, and then make your portfolios as much as you can weatherproof for the shocks which you can't predict. And when in Paris at ULI you discussed geopolitical risks, I mean, Paris is probably the right place to discuss geopolitical and asymmetric terrorist attacks and these things these days. That's another matter, but I think a waterproof portfolio in the first place is a sound basis for that unknown nature of risks.